All content provided by the Rational Investor is for educational and informational purposes only. It is based on academic principles in philosophy, psychology, and behavioral finance. We are not registered financial advisors. Nothing on this channel constitutes financial advice, investment recommendations, or an endorsement to buy or sell any security. Consult a qualified, registered financial professional before making any investment decisions. By watching our content, you agree to hold the Rational Investor harmless from any losses or damages resulting from your investment choices. If this approach to blending Stoic discipline with financial strategy resonates with you, I warmly invite you to join our community. Hit that subscribe button to get weekly documentaries that empower you to navigate markets with clarity and fortitude. For more on tackling cognitive biases, check out our playlist on Stoic investing principles, linked below. Let's keep building your portfolio strength together, one rational decision at a time.
Welcome to the Rational Investor, the definitive source for bridging ancient wisdom and modern wealth management. We specialize in high-level financial psychology, systematically dissecting the cognitive biases that sabotage investment success, from loss aversion and confirmation bias to the anchoring effect. Each documentary links the timeless wisdom of Stoic philosophers like Marcus Aurelius, Seneca, and Epictetus with specific, actionable strategies in quantitative and behavioral finance. Our mission is to help you master your mind, master your market. This channel is for serious investors, executives, and financial professionals who understand that superior returns are generated not by predicting the market, but by controlling the mind. If you are ready to build a portfolio of philosophical and financial fortitude, hit subscribe and join a community dedicated to emotional discipline and sustained, rational investing. New documentaries are published weekly. When everyone around you is buying the same stock, when financial media saturates every channel with the same narrative, when your colleagues at dinner parties can't stop discussing the latest market darling, this is precisely the moment your portfolio is in greatest danger. This is herd behavior, and it has destroyed more wealth than every market crash combined. The question you must ask yourself is this: why do intelligent, educated investors consistently abandon rational analysis the moment an investment becomes popular? 2,000 years ago, the Stoic philosopher Epictetus understood something that modern investors have forgotten: that the crowd's opinion is not just irrelevant to truth, it is actively hostile to it. In the next hour, I'm going to show you a systematic method rooted in Epictetan philosophy to recognize herd behavior before it devastates your returns, and more importantly, how to build the psychological immunity that separates wealth preservation from wealth destruction. Why your brain is wired to follow the crowd, and why that's costing you everything. Let's begin with an uncomfortable truth about your own psychology. You believe you're a rational, independent thinker. You've spent years developing your investment thesis, building your analytical frameworks, constructing your due diligence processes. Yet, if I examined your portfolio right now, and I mean truly examined it, I would find positions that you entered not because of superior analysis, but because everyone else was entering them too. This isn't a character flaw. This is neurobiology. Herd behavior, known in behavioral finance literature as informational cascades or social proof bias, is the cognitive tendency to align your decisions with the perceived decisions of the majority. It operates through a deceptively simple mechanism. When you observe others making a particular choice, your brain interprets their behavior as information, as evidence that this choice must be correct. The more people making the choice, the stronger the signal becomes. This is System 1 thinking at its most dangerous, the fast, automatic, intuitive processing that Daniel Kahneman describes in prospect theory. Your prefrontal cortex, the seat of System 2 analytical reasoning, is completely bypassed. Here's what makes herd behavior so insidious in financial markets. It feels rational in the moment. When you see institutional investors piling into a sector, when you read analyst reports all reaching the same bullish conclusion, when you observe price momentum confirming the narrative, your brain doesn't register this as blind conformity, it registers it as validation. You're not following the herd, you're recognizing an obvious opportunity that smart people have already identified. The psychological comfort is overwhelming. You're not alone in your decision. You're not taking an isolated risk. You have the implicit endorsement of the market's collective wisdom. But here's what your System 1 brain conveniently ignores. The crowd is not performing independent analysis. Each person in that crowd is looking at the same signals you are, the price momentum, the media coverage, the growing popularity, and making the same mistake. They're interpreting other people's behavior as information, creating a self-reinforcing feedback loop where the popularity of an investment becomes the primary evidence for the investment's validity. This is how bubbles form. This is how entire portfolios get concentrated in overvalued assets at precisely the wrong time. The financial manifestation is devastatingly predictable. You see it in the technology bubble of the late 90s, when investors abandoned every principle of valuation because internet stocks were different this time, and everyone was buying them. You see it in the real estate mania of 2007, when the crowd's enthusiasm for property convinced otherwise cautious investors to leverage themselves into mortgage-backed securities. You see it in the cryptocurrency euphoria of 2021, when the fear of missing out overwhelmed any rational assessment of intrinsic value. And you'll see it in the next bubble, and the one after that, because herd behavior isn't an aberration, it's the default setting of human cognition. The mechanism operates on multiple psychological levels simultaneously. There's the informational component I've described. You assume others possess knowledge you don't. There's also a deeper reputational concern. Making an unconventional choice that fails is psychologically more painful than making a conventional choice that fails. If you buy what everyone else is buying and it collapses, you can rationalize the loss as unavoidable, as something that happened to everyone. But if you stand apart from the crowd and you're wrong, you bear the full psychological weight of that error alone. Your brain is protecting you from regret, from the social cost of deviation, and in doing so, it's exposing you to far greater financial danger. This is why experienced investors often make their worst decisions during periods of maximum consensus. Your years of analytical training don't protect you because herd behavior operates beneath the level of conscious analysis. You don't realize you're following the crowd because you've constructed a rational narrative to explain your decision. You found the data points that support the popular thesis. You've dismissed the contradictory evidence as outdated or irrelevant. You've convinced yourself that this time the crowd has finally gotten it right. Now I want to take you back 2 millennia to Roman-occupied Greece, to the life of a man who had every reason to follow the crowd and every incentive to seek approval from those with power. Epictetus was born into slavery around 50 AD. He had no wealth, no status, no freedom. His entire existence was defined by external forces beyond his control. Yet this man, this slave who would eventually be freed and become one of history's most influential philosophers, developed a framework for psychological independence that is more relevant to your investment decisions today than any modern portfolio theory. The core of Epictetan philosophy is radical autonomy of judgment. In his discourses, Epictetus makes a claim that should fundamentally alter how you approach every investment decision. If you wish to be free, desire nothing and no one that belongs to others. Otherwise, you will necessarily be a slave. What he means is this: the moment you allow your judgment to be determined by external opinion, by what others think or do or value, you have surrendered your freedom. You have become enslaved to forces you cannot control. But Epictetus goes further. He doesn't just warn against following the crowd. He explains why the crowd's opinion is structurally worthless for decision-making. He writes, "When you see someone crying in sorrow because their child has gone away or their property is lost, beware that you are not carried away by the appearance. Instead, immediately make this distinction. What troubles him is not the event itself, for it does not trouble another person, but rather his judgment about it." Do you see what he's doing here? Epictetus is pointing out that reality itself is neutral. Events have no inherent meaning. The meaning comes entirely from the judgment we impose on them. And here's the crucial insight for investors. When you follow the herd, you are not responding to reality. You are responding to the crowd's judgment about reality, which is itself a collective delusion disconnected from facts. In Book 4 of the Discourses, Epictetus presents what I call the foundation of independent analysis. The beginning of philosophy is the recognition of the conflict between the opinions of men. It is the search for the origin of this conflict and the condemnation of mere opinion. It is the discovery of a standard of judgment. This is the entire methodology of rational investing compressed into 3 sentences. First, recognize that popular opinions about investments are in conflict with reality. Second, investigate why this conflict exists. Third, develop your own standard of judgment independent of popular opinion. Epictetus was particularly focused on what he called impressions, the automatic judgments your mind makes when encountering new information. He would teach his students to pause between the impression and the response, to examine whether the impression was accurate or whether it was simply reflecting popular delusion. He would say, first tell yourself what you want to be, then do what you have to do. In investment terms, first decide what kind of investor you want to be, rational, evidence-based, independent, then execute the disciplines necessary to become that investor, regardless of what the crowd is doing. The most powerful concept Epictetus offers us is his distinction between what is up to us and what is not up to us. Market prices are not up to you. Popular opinion about a stock is not up to you. Media narratives are not up to you. What is up to you? Your analysis, your judgment, your decision to buy or not buy, your emotional response to price movements. These are the only things you control, and therefore these are the only things that should concern you.
When Epictetus tells you that freedom is not procured by full enjoyment of what is desired, but by controlling the desire, he's giving you the key to defeating herd behavior. The crowd desires popularity, consensus, the comfort of agreement. If you can control that desire, if you can make yourself indifferent to whether your investment thesis is popular or not, you are free to analyze reality as it actually is, not as the crowd wishes it to be. This is not theoretical philosophy. This is operational psychology for serious investors. Epictetus is teaching you to build what modern psychologists call metacognition, the ability to observe your own thinking processes. When you feel the pull to buy because everyone else is buying, that's an impression. Epictetus would have you pause and ask, is this feeling based on my own analysis, or am I simply being carried along by the appearance of consensus? That pause, that moment of self-examination, is where rational investment begins. The 3-part framework: how to build Epictetan independence in your investment process. Now we move from philosophy to practice. Understanding Epictetus is valuable, but it's worthless if you can't systematically apply his principles to your portfolio decisions. What I'm about to give you is a 3-part operational framework that translates Epictetan philosophy into concrete investment discipline. This isn't theory, this is method. The first discipline is what I call the solitary analysis protocol. This is directly derived from Epictetus's insistence on examining your impressions before acting on them. Here's how it works in practice. Before you make any investment decision, before you even begin your research, you must commit to a period of complete informational isolation from popular opinion. I mean complete. No financial media, no analyst reports, no discussions with colleagues, no checking what prominent investors are saying on social media. You are going to analyze this investment as if you are the only person in the world who knows it exists. This sounds extreme, and it is, but it's necessary because herd behavior operates through information contamination. Once you know what the popular thesis is, your analysis will unconsciously bend toward it. You'll notice the data points that confirm it. You'll minimize the data points that contradict it. The solitary analysis protocol forces you to build your thesis from primary sources only: financial statements, regulatory filings, industry data, competitive analysis, management track record. You're looking at the business itself, not at what other people think about the business. The specific implementation looks like this. When you identify a potential investment, you schedule a dedicated analysis period, let's say 3 to 5 days for a significant position. During this period, your sources are restricted to primary documents only. You read the last 3 years of annual reports, you examine the cash flow statements line by line, you build your own financial models, you research the competitive landscape from industry publications, not from equity research reports that are already interpreting the data for you. You're doing the work that most investors have outsourced to analysts and media. At the end of this solitary analysis period, you write down your thesis. Not mentally, physically write it. Epictetus was a great advocate of writing because writing forces clarity of thought. Your thesis document should include your valuation, your expected return, your investment timeframe, the specific factors that would invalidate your thesis, and the maximum position size you're willing to allocate. This document is your standard of judgment, your philosophical touchstone. It represents your analysis before it was contaminated by popular opinion. Only after you've completed this solitary analysis do you allow yourself to examine what the market thinks. And here's the critical part. You're not looking for confirmation, you're looking for contradiction. You want to know what the crowd believes, so you can specifically examine whether their belief is justified by the facts you've already analyzed. If the popular thesis aligns with your independent analysis, that's fine, but it's not additional evidence. If the popular thesis contradicts your analysis, that's valuable information. Either you found something the crowd has missed, or the crowd has found something you've missed. Either way, you now have specific points to investigate further. The second discipline is the consensus inversion test. This comes directly from Epictetus's teaching about examining the conflict between opinion and reality. The framework is simple but psychologically difficult. Whenever you encounter an investment thesis that has achieved broad consensus, meaning institutional ownership is high, media coverage is overwhelmingly positive, and retail sentiment is bullish, your default assumption must be that the investment is mispriced in the wrong direction. Not certainly mispriced, but probably mispriced. Why this inversion? Because markets are efficient at incorporating widely known information into prices. When everyone knows something, when everyone agrees on the direction of a company or sector, that information is already fully reflected in the current price. The only way you generate superior returns is by knowing something the market doesn't know, or by correctly analyzing something the market has analyzed incorrectly. Consensus, by definition, means there is no informational edge remaining. The operational method here is to construct what I call the contrarian probability matrix. You take the popular investment thesis, let's say it's a technology company that everyone believes will dominate its market, and you systematically map out the specific conditions that would have to occur for that thesis to fail. Not vague risks, but concrete, identifiable scenarios. Then you assign probabilities to each scenario based on historical data and current evidence. For example, if the popular thesis assumes the company will maintain 40% revenue growth for the next 5 years, you research what percentage of companies in this sector have actually sustained 40% growth for 5 consecutive years historically. What specific competitive advantages does this company possess that previous high-growth companies lacked? What regulatory or technological changes could disrupt the growth trajectory? You're not trying to prove the thesis wrong. You're trying to honestly assess whether the probability of success justifies the current valuation, given what the market is already pricing in. Here's the key insight from Epictetus. The crowd's enthusiasm is not evidence. Their conviction is not data. When you hear phrases like, everyone knows this company is going to dominate, or this sector is obviously the future, those statements should trigger immediate skepticism, not comfort. Epictetus would say that these are impressions masquerading as judgments. Your job is to strip away the impression and examine the underlying facts. The consensus inversion test also requires you to actively seek out the dissenting opinions, the short sellers, the skeptics who are arguing against the popular position. This is psychologically uncomfortable because it feels like you're entertaining negativity or pessimism. But what you're actually doing is exposing yourself to alternative interpretations of the same dataset. You're testing whether your thesis can withstand intelligent criticism. If the only arguments you've considered are the arguments that support your position, you haven't actually analyzed anything. You've just confirmed your bias.
The third discipline, and perhaps the most important, is what I call the emotional audit protocol. This is pure Epictetus, the systematic examination of your own psychological state during the decision-making process. Because here's what most investors miss. Herd behavior doesn't just affect your analysis, it affects your emotions. And your emotions, if left unexamined, will override your analysis every single time. The emotional audit works like this. Before you execute any investment decision, you sit down with a journal, yes, an actual physical journal, and you answer a series of specific questions designed to reveal whether you're operating from rational analysis or from emotional contagion. The questions are, first, am I excited about this investment? If the answer is yes, that's a red flag. Excitement is an emotion, not an analytical conclusion. Epictetus would tell you that excitement means you've attached your internal state to an external outcome you don't control. Good investments should produce calm confidence, not excitement. If you're excited, it usually means you're responding to momentum, to popularity, to the fear of missing out, all forms of herd behavior. Second, would I make this investment if no one else knew about it? This question cuts directly to the heart of social proof bias. If your honest answer is that you'd be less inclined to invest if it weren't popular, then you're not investing based on analysis. You're investing based on the comfort of consensus. Epictetus's test of freedom applies here. Are you making this decision because you've independently judged it to be correct, or because you desire the approval that comes from making the same decision as respected investors? Third, what am I afraid will happen if I don't make this investment? This reveals fear of missing out, which is herd behavior's most powerful emotional driver. If your fear is that you'll miss profits while others profit, that's a social comparison, not an investment thesis. If your fear is that you'll look foolish for not participating in an obvious opportunity, that's reputational concern, not financial analysis. Epictetus would remind you that other people's returns are not up to you. Their opinions of your decisions are not up to you. The only thing up to you is whether your decision process was rational. Fourth, if this investment declined by 30% immediately after I purchased it, would I add to the position or exit it? This question reveals whether you actually believe in your analysis or whether you're just riding momentum. If a 30% decline would cause you to sell, it means your conviction was based on price action and popularity, not on valuation and fundamentals. True Epictetan investors welcome price declines in assets they've correctly analyzed because it means they can acquire more value at better prices. The emotional audit protocol isn't just introspection, it's documentation. You write down your answers, you date them, you save them, and critically, you review them after the investment plays out. This creates a feedback loop where you can see, with painful clarity, the patterns of emotional decision-making that cost you money. Over time, the act of knowing you'll have to document your emotional state becomes itself a discipline that prevents herd behavior before it starts. These three disciplines, the solitary analysis protocol, the consensus inversion test, and the emotional audit protocol, form what I call the Epictetan investment framework. They're not complicated. They don't require advanced mathematics or proprietary data. What they require is psychological discipline, the willingness to stand apart from the crowd, and the courage to trust your own judgment even when that judgment is unpopular. Epictetus taught that philosophy is not about learning clever arguments, it's about training yourself to see reality clearly and act accordingly. These disciplines are that training applied to investment management. They force you to confront the specific psychological mechanisms through which herd behavior operates, and they give you concrete methods to resist those mechanisms before they damage your portfolio. Now, before we continue deeper into the practical applications, I want to remind you why you're here. You're watching this because you understand that the market rewards discipline, not enthusiasm. You know that superior returns come from superior thinking, not from following popular trends. If you haven't already subscribed to The Rational Investor, do it now. Every week, we publish documentaries like this one that give you the philosophical and psychological tools to separate yourself from the herd. We're building a community of investors who think independently, who value evidence over emotion, and who understand that mastering your mind is the only reliable path to mastering the market. Click subscribe, turn on notifications, and commit to becoming the kind of investor who profits from rationality while others are swept away by popularity.
But what about when the crowd is actually right? How do you know when consensus reflects reality? This is the question that paralyzes intelligent investors. You've learned to be skeptical of popular opinion, you've built your framework for independent analysis, but now you're facing a situation where every rational indicator seems to align with what everyone else is saying. The company has strong fundamentals, the valuation appears reasonable, management is executing flawlessly, and yet everyone agrees. Every analyst has a buy rating. Every fund manager is overweight the position, the media coverage is universally positive. So here's your dilemma. Is this one of those rare moments when the crowd has actually identified genuine value? Or is this the setup for a spectacular collapse? Let me give you the Epictetan answer first, then we'll build the practical framework. Epictetus would tell you that the question itself is malformed. You're asking whether external opinion, the crowd's judgment, corresponds to objective reality. But that's not actually what matters for your investment decision. What matters is whether your own analysis, conducted independently using primary evidence, has led you to the same conclusion that the crowd has reached. If it has, then the crowd's agreement is irrelevant. If it hasn't, then the crowd's agreement is dangerous. Here's the critical distinction that most investors miss. There's a profound difference between arriving at the same conclusion as the crowd through independent analysis and adopting the crowd's conclusion because it's the crowd's conclusion. The outcome looks identical. You end up holding the same popular position, but the psychological and financial implications are completely different. In the first case, you have genuine conviction based on evidence. You understand specifically why the investment is valuable, what could invalidate that thesis, and at what price you should exit. In the second case, you have borrowed conviction. Your entire position is dependent on the crowd continuing to believe what they currently believe. The moment sentiment shifts, you have no framework for deciding whether to hold or sell because you never had an independent thesis to begin with. So the operational framework here is what I call the convergence verification protocol. When your independent analysis reaches the same conclusion as popular consensus, you don't celebrate, you investigate. You're looking to verify that your reasoning is genuinely independent, not that you've unconsciously absorbed the crowd's narrative and retrofitted your analysis to match it. Here's how you execute this verification. You take your written investment thesis, the one you created during your solitary analysis protocol, and you compare it point by point with the popular thesis. Not generally, but specifically. What are the exact reasons the crowd is bullish on this investment? Write them down. Now look at your thesis. Are your reasons identical to theirs, or are they different? If they're identical, that's actually a warning sign. It suggests your analysis may have been contaminated by popular opinion, even during your supposedly isolated research period. Information has a way of seeping in through indirect channels, the questions analysts ask on earnings calls, the metrics that financial media emphasizes, the frameworks that become industry standard. If your reasons are different, if you've identified value drivers or risks that aren't part of the popular narrative, then you have genuine analytical independence, even though your conclusion matches the crowd's. Let me give you a concrete example. Suppose everyone is bullish on a particular technology company because they believe it will dominate the artificial intelligence market. That's the popular thesis. Your independent analysis also makes you bullish, but for a different reason. You've identified that the company has an undervalued semiconductor IP portfolio that provides a durable competitive moat regardless of how the AI market evolves. Same bullish conclusion, different reasoning. That's genuine independence. But here's the critical next step. You need to identify what would cause the crowd to change its mind versus what would cause you to change your mind. If those triggers are the same, you're still in herd behavior territory. Using our example, if both you and the crowd would become bearish the moment AI adoption slows, then you're all responding to the same stimulus. You're part of the herd. But if the crowd's bearish trigger is AI adoption slowing, while your bearish trigger is the company losing its IP advantages through litigation or technological disruption, then you have independent decision criteria. You can watch the crowd panic over AI headlines while maintaining your position because your thesis isn't threatened by those headlines. This brings us to Epictetus' teaching about attachments. He would say that if you're constantly monitoring what the crowd thinks about your position, you've become attached to external validation. You're a slave to popular opinion, even when you happen to agree with it. The Epictetan investor makes a decision based on independent analysis, executes that decision, and then becomes indifferent whether the crowd agrees or disagrees. The crowd's opinion provides no additional information because you've already analyzed the same facts they have access to, and you've reached your conclusion through your own reasoning.
Now, there's a second layer to your question. What about situations where the crowd's behavior itself creates the investment reality? This is the reflexivity problem that George Soros identified. Sometimes popular belief actually makes itself true through self-fulfilling mechanisms. If everyone believes a company will succeed, they buy the stock price rises, the company can raise capital cheaply, use that capital to grow, and actually become successful. The crowd's belief created the outcome. Epictetus has an answer here too, though you have to extract it carefully from his teachings. He would point out that you're confusing correlation with causation, appearance with reality. Yes, the price went up because the crowd bought, but did the underlying business value increase proportionally? Did the company's competitive position actually strengthen, or did it just get expensive? Price and value are not the same thing. The crowd can push prices far above value for extended periods, and during those periods, it appears that the crowd was right. But Epictetus would remind you that appearance is not reality. Eventually, price reverts to value. The only question is when and whether you have the psychological discipline to wait. The practical framework for handling reflexive situations is to separate your analysis into two components, the business value and the price momentum. You can acknowledge that momentum exists, that the crowd's buying is pushing prices higher, without allowing that momentum to influence your assessment of underlying value. This is where most investors fail. They see the price rising, they see the crowd enthusiastically buying, and they unconsciously revise their value estimates upward to justify the new price. They tell themselves, the business must be worth more than they initially thought because the market is saying so. This is herd behavior disguised as updated analysis. The Epictetan approach is to hold your value estimate constant unless new fundamental information, not price movement, not sentiment, but actual business data changes the underlying cash flows or competitive position. If your analysis says the business is worth $50 per share and the crowd pushes it to $80 per share, you don't ask, what did I miss? You ask, what is the crowd assuming that I'm not assuming?
Write down those assumptions explicitly, then evaluate whether those assumptions are realistic based on historical precedent and current evidence. Here's a personal discipline I use that comes directly from Epictetan principles. When I find myself agreeing with popular consensus, I force myself to write what I call a contrarian exit memo before I enter the position. This document specifies the exact conditions under which I would sell the investment, even if the crowd is still buying, even if the price is still rising, even if the popular narrative remains intact. These conditions are based purely on fundamental deterioration, declining competitive advantages, market share losses, management execution failures, technological disruption. The reason this discipline is so powerful is because it forces you to define your investment thesis in terms that are independent of price and popularity. When you know in advance that you'll exit if the company loses a major customer, you're not tempted to rationalize holding the position just because everyone else is still holding it. You've pre-committed to your own standard of judgment. This is Epictetus's dichotomy of control applied to portfolio management. You can't control what the crowd does. You can control your entry criteria and exit criteria. One final point on this question. There's a dangerous myth in investing that you need to respect the market or respect the trend, and this myth causes investors to abandon independent analysis in favor of following momentum. Let me be clear about what Epictetus would say about this. You should respect reality. You should respect evidence. You should respect the fundamental laws of business economics. But you should have zero respect for the crowd's opinion simply because it's the crowd's opinion. The market, meaning the collective behavior of buyers and sellers, is not some omniscient entity that knows more than you do. It's a crowd of individuals, most of whom are responding to the same psychological biases you're trying to overcome. When someone tells you the market is telling you something, they're actually telling you that popular opinion has shifted. That's information about sentiment, not information about value. Sentiment matters for short-term price movements, but if you're investing based on long-term value creation, sentiment is noise. Epictetus would call it an external, something not up to you, something you cannot control, and therefore something you should make yourself indifferent to. So, to directly answer your question, when the crowd is right, it's right by accident or by coincidence, not by methodology. Your job is not to determine when the crowd is right. Your job is to develop your own methodology for determining what's right, and then to execute that methodology with discipline, regardless of whether the crowd agrees with you or not. Sometimes they will, sometimes they won't. If you've done the work, if you've conducted genuine independent analysis using primary sources and rigorous reasoning, then the crowd's opinion adds nothing to your knowledge and should influence nothing in your decision-making.
But there's a second, subtler factor at work. The professionalization of investment analysis itself creates herd behavior through shared frameworks. Think about how professional investors are trained. They attend the same business schools, they learn the same valuation methodologies, they use the same financial modeling software, they read the same research reports, they attend the same industry conferences. They're all exposed to the same information processed through the same analytical frameworks. Is it any surprise that they reach the same conclusions? This is what Epictetus meant when he talked about examining the origin of conflict between opinions. Professional investors don't have conflicting opinions because they've all been trained to process information identically. When a new piece of data emerges, an earnings report, a regulatory change, a technological disruption, every analyst runs it through essentially the same model and arrives at essentially the same output. They think they're doing independent analysis, but they're actually just independently executing the same standardized algorithm. Here's where it gets truly insidious. The few investors who do develop genuinely independent frameworks get filtered out by the institutional environment. If you're a young analyst proposing an investment that contradicts the firm's established view, contradicts what the senior portfolio managers believe, contradicts what your clients expect, your idea will be rejected before it's even seriously considered.
You'll be told you're not being realistic, or you're not thinking about the risks, or you don't understand the business model. What's really being said is, your thinking is dangerously unconventional, and unconventional thinking threatens the stability of our conventional business model. So the young analyst learns quickly. To advance in your career, you need to think like everyone else thinks, just slightly better. You need to reach the consensus conclusion, but reach it faster, or with more supporting evidence, or with better articulation. You don't need original insight, you need to be incrementally better at confirming what everyone already believes. Over time, this selection pressure produces an entire industry of highly intelligent people who are psychologically incapable of independent thought because independent thought has been systematically discouraged throughout their career development. Now, let's connect this to your actual investment strategy. The fact that professional investors exhibit herd behavior is not a problem for you. It's an opportunity. When you see institutional ownership concentrating in certain stocks or sectors, when you see analyst consensus becoming uniform, when you see professional investors articulating identical narratives about market direction, you're watching capital crowd into positions that are likely already fully valued or overvalued. This creates inefficiency. It creates opportunities in the areas that professionals are ignoring or avoiding, because those areas are unconventional or unfashionable. The Epictetan framework here is to recognize that professional investors' lack of independence is a structural feature of their business model, not a temporary aberration. They will always tend toward herd behavior because their incentives reward short-term conformity over long-term performance. You, assuming you're managing your own capital or managing capital with a long-term mandate, don't face those same constraints. You can afford to be wrong for longer than a professional investor can afford to be unconventional. This is your competitive advantage. But, and this is critical, you can only exploit this advantage if you resist the temptation to use professional investor behavior as a signal. The most dangerous form of herd behavior for sophisticated individual investors is following what smart institutional investors are doing. You see that a respected hedge fund has taken a position, and you think, they must know something I don't. But what you're actually observing is their response to the same career and reputational pressures I've described. Their position might be genuinely insightful, or it might be a conventional move dressed up as insight. You have no way to distinguish between the two unless you do your own independent analysis. Epictetus would tell you to focus on what's up to you, your own analytical process, your own reasoning, your own judgment. The fact that professional investors reached a particular conclusion tells you nothing about whether that conclusion is correct. It tells you only that they reached it. If your independent analysis leads you to the same conclusion, fine. If it leads you to a different conclusion, that's also fine. What's not fine is allowing their conclusion to substitute for your analysis. There's one more layer to this question that we need to address: social proof among retail investors versus social proof among institutional investors. When retail investors follow the crowd, they're usually following momentum. They see prices rising and they buy because they assume the rising price indicates that others know something valuable. When institutional investors follow the crowd, they're following credentials and reputation. They see that other respected institutions are taking a position, and they assume those institutions have done rigorous analysis. Both are forms of herd behavior, but they operate through different psychological mechanisms. The retail investor following momentum can be shaken out easily when prices reverse. He has no analytical foundation for his position. But the institutional investor following credentials often has more persistent conviction because he's constructed an elaborate rationalization for his herd behavior. He's told himself that he's not following the crowd, he's agreeing with smart people based on their track record. This makes institutional herd behavior actually more dangerous in some ways because it's more resistant to contrary evidence. Your defense against both forms of herd behavior is the same: a systematic application of the Epictetan framework I've laid out. You conduct your solitary analysis protocol. You execute your consensus inversion test. You perform your emotional audit, and you commit to the principle that no external opinion, no matter how credentialed or respected, can substitute for your own reasoning. This is psychological discipline. This is what separates investors who preserve and compound wealth over decades from investors who achieve temporary success followed by spectacular failures. So, to directly answer your question, professional investors don't practice independent thinking because their business model punishes independent thinking more than it rewards superior performance. They're trapped in a system that demands conformity while claiming to value innovation. But you're not trapped in that system unless you choose to be. The question is whether you have the discipline to stand alone when standing alone is necessary, and whether you can maintain your analytical independence even when the smartest people in the room are telling you you're wrong.
How do you distinguish between rational contrarianism and just being stubborn? When should you actually listen to what markets are telling you? This is perhaps the most difficult question an independent investor faces, and it's where most attempts at Epictetan independence fail. You've learned to be skeptical of popular opinion. You've developed your independent analytical framework. You've taken a position that contradicts consensus. And then the market moves against you. Prices decline, the popular narrative strengthens, more data emerges that seems to support the crowd's view rather than yours. At what point do you admit you are wrong? At what point does independent thinking become stubborn denial? Let me start with what Epictetus would consider a false distinction in your question. You're asking how to distinguish between contrarianism and stubbornness, but Epictetus would say neither of those is the correct framework. Contrarianism is still a form of dependence on the crowd. You're defining your position in opposition to popular opinion rather than in response to evidence. If the crowd says buy and you automatically say sell, you're still letting the crowd determine your decision-making. You've just inverted the relationship. True Epictetan independence means you arrive at your conclusion without reference to what the crowd believes. Sometimes that conclusion will align with popular opinion, sometimes it will contradict it, but the crowd's opinion plays no role in your reasoning process. Similarly, stubbornness is a refusal to update your beliefs in response to new evidence, but the Epictetan investor is constantly updating his beliefs. He's just updating them based on evidence about reality, not evidence about what other people believe. The question you should be asking is not when should I listen to markets, but what evidence would falsify my investment thesis, and have I encountered that evidence? Here's the operational framework. When you establish any investment position, you must simultaneously establish, in writing, the specific falsification criteria for that position. These are the concrete, observable facts that, if they occurred, would prove your thesis wrong, not prove the crowd right, prove your thesis wrong. This is Karl Popper's falsification principle applied to portfolio management, and it's completely consistent with Epictetan philosophy. Let me give you specific examples of proper falsification criteria versus improper criteria. Improper criterion. If the stock declined 20%, I was wrong. That's not a falsification criterion, that's just price movement. Price can diverge from value for extended periods for reasons that have nothing to do with the correctness of your analysis. Proper criterion. If the company's gross margin compresses by more than 5 percentage points without a corresponding increase in market share, my thesis about competitive advantage is falsified. Improper criterion. If the analysts downgrade the stock to sell, I should reconsider. Analyst opinion is just another form of popular opinion. It's not evidence about the underlying business. Proper criterion. If the company's gross margin compresses by more than 5 percentage points without a corresponding increase in market share, my thesis about competitive advantage is falsified. Do you see the difference? Proper falsification criteria are about the business fundamentals that underpin your investment thesis. They're objective, measurable, and directly relevant to the reasons you invested in the first place. Improper falsification criteria are about price, sentiment, or consensus, all external factors that Epictetus would tell you are not up to you and should not influence your judgment.
Now, here's where this gets psychologically difficult. Your falsification criteria need to be established before you enter the position, and you need to commit to executing them mechanically when they're triggered. This is hard because once you're in a position, your brain becomes invested in being right. You'll rationalize, you'll explain away evidence that contradicts your thesis, you'll tell yourself the metrics are temporarily distorted or the market is misunderstanding the situation. This is cognitive dissonance, and it's one of the most powerful psychological forces working against rational investing. The Epictetan solution is to separate the decision-making process from the emotional experience of being wrong. Epictetus teaches that events themselves are neutral. It's only our judgment about events that causes emotional disturbance. Being wrong about an investment is just information. It's feedback about the accuracy of your analytical model. It's not a commentary on your intelligence or worth as a person. But most investors can't separate these things. They experience being wrong as a personal failure, and because that experience is painful, they avoid acknowledging error, even when error is obvious. Here's a specific discipline I use that comes from Stoic philosophy. I maintain what I call a falsification journal. Every time I establish a position, I write the falsification criteria in this journal, along with the date and my reasoning for the investment. Then, quarterly, I review every position against its falsification criteria. This review is not about whether I'm making money, it's about whether the business fundamentals that justified my thesis are still intact. If a falsification criterion has been triggered, I exit the position, regardless of whether it's profitable or not, regardless of whether the crowd agrees with me or not. This sounds simple, but it requires genuine psychological discipline. I've exited positions that were up 30% because a key falsification criterion was triggered, and I later watched those positions decline by 50%. I've also exited positions that were down 20% because falsification criteria were triggered, and I later watched them decline to zero. In both cases, the discipline protected me from worse outcomes. But the critical point is, I couldn't have executed this discipline if I was monitoring what the market or the crowd thought about my positions. I had to be focused exclusively on whether the business fundamentals that justified my thesis were still valid.
How do you distinguish between rational contrarianism and just being stubborn? When should you actually listen to what markets are telling you? This is perhaps the most difficult question an independent investor faces, and it's where most attempts at Epictetan independence fail. You've learned to be skeptical of popular opinion. You've developed your independent analytical framework. You've taken a position that contradicts consensus. And then the market moves against you. Prices decline. The popular narrative strengthens. More data emerges that seems to support the crowd's view rather than yours. At what point do you admit you were wrong? At what point does independent thinking become stubborn denial? Let me start with what Epictetus would consider a false distinction in your question. You're asking how to distinguish between contrarianism and stubbornness, but Epictetus would say neither of those is the correct framework. Contrarianism is still a form of dependence on the crowd. You're defining your position in opposition to popular opinion rather than in response to evidence. If the crowd says buy and you automatically say sell, you're still letting the crowd determine your decision-making. You've just inverted the relationship. True Epictetan independence means you arrive at your conclusion without reference to what the crowd believes. Sometimes that conclusion will align with popular opinion, sometimes it will contradict it, but the crowd's opinion plays no role in your reasoning process. Similarly, stubbornness is a refusal to update your beliefs in response to new evidence. But the Epictetan investor is constantly updating his beliefs. He's just updating them based on evidence about reality, not evidence about what other people believe. The question you should be asking is not when should I listen to markets, but what evidence would falsify my investment thesis, and have I encountered that evidence? Here's the operational framework. When you establish any investment position, you must simultaneously establish, in writing, the specific falsification criteria for that position. These are the concrete, observable facts that, if they occurred, would prove your thesis wrong. Not prove the crowd right, prove your thesis wrong.
This is Karl Popper's falsification principle applied to portfolio management, and it's completely consistent with Epictetan philosophy. Let me give you specific examples of proper falsification criteria versus improper criteria. Improper criterion. If the stock declines 20%, I was wrong. That's not a falsification criterion. That's just price movement. Price can diverge from value for extended periods for reasons that have nothing to do with the correctness of your analysis. Proper criterion. If the company loses market share for 3 consecutive quarters while competitors gain share in the same market, my thesis about competitive advantage is falsified. Improper criterion. If analysts downgrade the stock to sell, I should reconsider. Analyst opinion is just another form of popular opinion. It's not evidence about the underlying business. Proper criterion. If the company's gross margin compresses by more than 5 percentage points without a corresponding increase in market share, my thesis about economies of scale is falsified. Do you see the difference? Proper falsification criteria are about the business fundamentals that underpin your investment thesis. They're objective, measurable, and directly relevant to the reasons you invested in the first place. Improper falsification criteria are about price, sentiment, or consensus, all external factors that Epictetus would tell you are not up to you and should not influence your judgment. Now, here's where this got psychologically difficult. Your falsification criteria need to be established before you enter the position, and you need to commit to executing them mechanically when they're triggered. This is hard because once you're in a position, your brain becomes invested in being right. You'll rationalize. You'll explain away evidence that contradicts your thesis. You'll tell yourself the metrics are temporarily distorted, or the market is misunderstanding the situation. This is cognitive dissonance, and it's one of the most powerful psychological forces working against rational investing. The Epictetan solution is to separate the decision-making process from the emotional experience of being wrong. Epictetus teaches that events themselves are neutral. It's only our judgment about events that causes emotional disturbance. Being wrong about an investment is just information. It's feedback about the accuracy of your analytical model. It's not a commentary on your intelligence or worth as a person. But most investors can't separate these things. They experience being wrong as a personal failure, and because that experience is painful, they avoid acknowledging error when error is obvious. Here's a specific discipline I use that comes from Stoic philosophy. I maintain what I call a falsification journal. Every time I establish a position, I write the falsification criteria in this journal along with the date and my reasoning for the investment. Then, quarterly, I review every position against its falsification criteria. This review is not about whether I'm making money. It's about whether the business fundamentals that justified my thesis are still intact. If a falsification criterion has been triggered, I exit the position regardless of whether it's profitable or not, regardless of whether the crowd agrees with me or not. This sounds simple, but it requires genuine psychological discipline. I've exited positions that were up 30% because a key falsification criterion was triggered, and I later watched those positions decline by 50%. I've also exited positions that were down 20% because falsification criteria were triggered, and I later watched them decline to 0. In both cases, the discipline protected me from worse outcomes, but the critical point is I couldn't have executed this discipline if I was monitoring what the market or the crowd thought about my positions. I had to be focused exclusively on whether the business fundamentals that justified my thesis were still valid. Now, let's address the second part of your question. When should you listen to what markets are telling you? The Epictetan answer is never and always, depending on what you mean by listen. You should never allow price movements to influence your assessment of business value. Price is determined by the collective psychology of buyers and sellers, and collective psychology is subject to all the biases and errors we've been discussing. Price can be 50% below value or 50% above value for years at a time. If you're using price movement as evidence about business quality, you're letting the crowd think for you. But you should always pay attention to market structure and market behavior as information about risk and opportunity. If a stock you own suddenly experiences a massive spike in short interest, that's not necessarily evidence that you're wrong, but it is evidence that sophisticated investors have reached a conclusion opposite to yours. That should trigger investigation. What do they see that you don't see? Have they identified a falsification criterion that you missed? You're not accepting their conclusion, but you're examining their reasoning. Similarly, if you're finding that the market is consistently offering you opportunities to buy businesses at prices far below your calculated value, that's information. Either you're correctly identifying undervalued assets that the market is mispricing, or your valuation methodology is flawed and you're systematically overestimating business value. The way to determine which is true is to track your results over time. Are the undervalued businesses you identified actually generating the returns you predicted? If yes, then market prices are indeed disconnected from value, and you should keep executing your strategy. If no, then your valuation model needs revision. This brings us to what I consider the most important discipline for maintaining independent thinking while remaining responsive to evidence. You need a systematic process for distinguishing between temporary price volatility and permanent value impairment. Most investors can't make this distinction because they're reacting emotionally to portfolio values rather than analytically to business fundamentals. Here's the framework. Every time a position declines significantly, let's say by 25% or more, you conduct what I call a thesis verification audit. You pull out your original written thesis, you examine whether any of your falsification criteria have been triggered. If they haven't, you then ask, has any new fundamental information emerged that contradicts the core assumptions of my thesis? Not price information, not sentiment information, fundamental information about the business's competitive position, its management quality, its financial strength, its market opportunity. If the answer is no, if your falsification criteria haven't been triggered and no new contradictory fundamental information has emerged, then the price decline is noise. It's the crowd being the crowd. Your correct response is not to sell in panic and not to stubbornly hold while hoping for recovery. Your correct response is to examine whether the decline has created an opportunity to add to your position at better prices. This is what Buffett means when he says, be greedy when others are fearful. But notice, you can only be greedy when others are fearful if you have genuine independent conviction about the value you're buying. If you're part of the herd, fear is contagious. Conversely, if your thesis verification audit reveals that falsification criteria have been triggered or that new contradictory fundamental information has emerged, then the price decline is signal, not noise. The market may be recognizing a deterioration in business fundamentals before that deterioration shows up in the financial statements. This is when you need to override your ego, admit error, and exit the position. The crowd's behavior isn't telling you what to think, your own falsification criteria are telling you what to do. Let me give you a concrete historical example to illustrate this distinction. In the early 2000s, many value investors bought newspaper businesses because they appeared cheap based on traditional metrics, low price-to-earnings ratios, strong cash flows, established market positions. As internet advertising began to grow, newspaper stocks declined. The question each investor faced was, is this price decline noise or signal? If your original thesis was newspapers have durable competitive advantages based on local market monopolies and high barriers to entry, the emergence of internet advertising was a falsification event. It directly contradicted your thesis about barriers to entry and competitive advantage. The correct response was to exit, regardless of how cheap the stocks became. Investors who said, I'm being contrarian, and held newspaper stocks as they declined another 70 or 80%, weren't being independent, they were being stubborn. They were refusing to acknowledge that their thesis had been falsified. But if your thesis was, newspapers are temporary businesses that will decline over time, but their current cash flows are so strong that even in decline, they'll generate returns that exceed my cost of capital, then price declines weren't necessarily falsification events. You expected decline. Your falsification criterion would be something like cash flow declines at a rate faster than projected. Some investors who held this thesis actually generated positive returns from newspaper businesses even as the industry collapsed, because they were managing to their own specific falsification criteria rather than reacting to popular panic. The final point I want to make on this question is about the timeline of validation. Epictetus would remind you that you're immortal in your judgments, but mortal in your body. In investment terms, your thesis about value might require 5 or 10 years to prove correct, but your career or your client relationships or your personal financial situation might not survive 5 or 10 years of underperformance. This creates a real tension between long-term conviction and short-term reality. The Stoic solution is not to ignore this tension, but to structure your life so you can afford to be patient. This means managing your own expenses and obligations so you're not forced to liquidate positions at unfavorable times. It means communicating clearly with clients or partners about your investment philosophy and timeline so they understand that underperformance is an expected part of value investing. It means being honest with yourself about your own psychological capacity to tolerate being wrong for extended periods. If you know you'll panic during a 3-year period of underperformance, then you need to adjust your either psychology or your strategy. Epictetus would say, know yourself, accept your limitations, and structure your circumstances accordingly.
So to bring this full circle, you distinguish rational independence from stubborn denial not by looking at price performance or crowd opinion, but by examining whether your predefined falsification criteria have been triggered. You listen to markets not as sources of value judgment, but as sources of information about business fundamentals and opportunities for better pricing. You maintain flexibility in your tactics while remaining firm in your principles. And you commit to the discipline of written documentation, systematic review, and mechanical execution of falsification criteria, even when that execution is psychologically painful. This is Epictetan independence applied to portfolio management. It's not about always being right. It's about having a systematic process for determining when you're wrong and responding to that determination without ego or emotion. Why this ancient wisdom still matters more than any modern portfolio theory. We've covered substantial ground in this discussion. We've examined the psychological mechanisms of herd behavior, the Epictetan framework for independent thinking, and the specific operational disciplines that translate philosophy into portfolio management. But I want to bring us to the fundamental question that underlies everything we've discussed. Why does any of this matter? Why should you, a sophisticated investor with access to modern analytical tools and quantitative models, care what a Roman slave philosopher thought about independence and judgment? The answer is that every advance in financial technology, every new analytical framework, every quantitative model that's been developed in the past century has made markets more efficient at processing information, but none of it has made investors more rational. We have better data than ever before. We have computational power that can analyze millions of data points in seconds. We have academic research that has identified and categorized every cognitive bias that affects decision-making. And yet, bubbles still form, investors still panic during crashes, crowds still pile into overvalued assets at precisely the wrong time. The technology has changed, but human psychology hasn't. This is what Epictetus understood that modern finance theory misses. The limiting factor in investment success is not analytical capability, it's psychological discipline. You don't need a more sophisticated model for calculating fair value. You need the discipline to act on your analysis, even when doing so is socially uncomfortable, professionally risky, or emotionally difficult. You don't need better information about what other investors are doing. You need the independence to make decisions without reference to what other investors are doing. These are not analytical problems. These are philosophical problems. Modern portfolio theory assumes that investors are rational actors who process information efficiently and update their beliefs based on evidence. But behavioral finance has spent the past 50 years documenting that this assumption is false. Investors are not rational, they're emotional, biased, and profoundly influenced by social dynamics. The question is not whether you're subject to these biases. The question is whether you have a systematic method for overcoming them. That's what Epictetus philosophy provides. When Epictetus tells you to distinguish between what's up to you and what's not up to you, he's giving you a framework that's more valuable than any discounted cash flow model. Because once you truly internalize that framework, once you genuinely stop caring about external validation and focus exclusively on the quality of your analytical process, you become immune to the psychological forces that drive herd behavior. You stop checking what other investors think. You stop monitoring whether your position is popular. You stop feeling anxious when your portfolio deviates from benchmark indices. All of that anxiety, all of that psychological noise comes from allowing your internal state to depend on external circumstances. Epictetus teaches you to sever that dependence. This is why the Stoics were so focused on what they called spiritual exercises, practices that train the mind to respond to circumstances with reason rather than emotion. The frameworks I've given you, the solitary analysis protocol, the consensus inversion test, the emotional audit protocol, the falsification journal, these are spiritual exercises for investors. They're systematic practices that, over time, reshape how your brain responds to market information and social pressure. You're not just learning a new investment strategy, you're training yourself to think differently at a fundamental level. Let me be very specific about what this means in practical terms. If you implement the Epictetan framework consistently for 2 or 3 years, you will start to notice something strange happening in your psychology. You'll encounter situations that used to trigger anxiety, a position declining while everyone else's similar positions are rising, a contrarian thesis that makes you look foolish at dinner parties, an investment opportunity that no one else seems to recognize, and you'll find that these situations no longer produce emotional responses, not because you've become calloused or disconnected, but because you've trained yourself to locate your sense of competence and worth in your analytical process rather than in your outcomes or in others' opinions of your outcomes.
This psychological shift has enormous financial implications. When you're no longer anxious about being different from the crowd, you can hold positions through periods of temporary underperformance that would cause other investors to panic and sell. When you're no longer seeking validation from popular opinion, you can buy assets that are unfashionable but undervalued. When you're no longer disturbed by volatility, you can think clearly during market dislocations and identify opportunities while others are paralyzed by fear. These advantages compound over time into substantial performance differentials. But, and this is crucial, these advantages only accrue if you're actually right in your analysis more often than you're wrong. Epictetan independence without analytical competence is just contrarianism, and contrarianism is not a valid investment strategy. You need both elements: the psychological discipline that Epictetus provides and the analytical rigor that comes from studying businesses, understanding competitive dynamics, and developing genuine expertise in valuation. Neither element alone is sufficient. Both elements together create what Munger calls a lattice work of mental models, a framework that's both psychologically robust and analytically sound. This is why I started this documentary by connecting Epictetus directly to behavioral finance concepts like System 1 and System 2 thinking, informational cascades, and social proof bias. I'm not suggesting that philosophy replaces financial analysis. I'm showing you that philosophy and finance are addressing the same fundamental problem from different angles. Behavioral finance identifies the cognitive biases that sabotage investment decisions. Stoic philosophy provides the training method for overcoming those biases. You need both. And here's something that I think gets lost in most discussions of investing. This work of mastering your psychology, of training yourself to think independently and act rationally under pressure, this work is never finished. You don't achieve Epictetan independence once and then coast on that achievement. Every day, Every investment decision, every market environment presents new tests of your discipline. You will have moments where you slip back into herd behavior. You will have periods where you convince yourself that this time really is different, that the crowd really has identified genuine value. The goal is not to achieve perfect independence. The goal is to develop systematic practices that help you recognize when you're deviating from independence and correct course before those deviations become catastrophic. This is what Epictetus meant when he said that philosophy is not about clever arguments, it's about daily practice. The wealthy investor who reviews his falsification journal every quarter is doing philosophy. The fund manager who conducts an emotional audit before every major position is doing philosophy. The individual investor who forces himself through the solitary analysis protocol, even when it's tedious and time-consuming, is doing philosophy. These are not abstract intellectual exercises. They're the actual work of building psychological immunity to the biases that destroy wealth. Let me tell you what happens to investors who ignore this work, who believe that intelligence and analytical skill are sufficient without psychological discipline. They perform brilliantly during calm markets, when information flows are clear and there's time for careful analysis. But during periods of crisis, during periods of euphoria, during any period when emotional intensity is high and the crowd's behavior is most extreme, they fall apart. They panic during crashes and sell at the bottom. They get swept up in manias and buy at the top. They make their worst decisions at the most critical moments because they've never trained themselves to remain calm and rational when everyone around them is losing their minds. You've seen this pattern repeatedly throughout financial history. Long-term capital management, one of the most intellectually sophisticated hedge funds ever created, staffed by Nobel Prize winners and PhDs, collapsed because they couldn't maintain their discipline during a crisis. Their models were correct, their analysis was sound, but when the market moved against them and fear became overwhelming, they couldn't execute the strategy their own models were telling them to execute. That's not an analytical failure. That's a philosophical failure. Contrast that with investors like Buffett, Munger, Howard Marks, Seth Klarman, investors who have consistently generated superior returns over decades. Yes, they're analytically brilliant, but more importantly, they've trained themselves to remain psychologically independent, even when that independence is most difficult. They buy when others are panicking, not because they're braver, but because they've systematically prepared themselves for that moment through years of philosophical discipline. They've internalized Epictetan framework so deeply that their natural response to crisis is rational analysis rather than emotional reaction. This is what I mean when I say that mastering your mind is the prerequisite for mastering the market. The market will always present opportunities. There will always be assets that become disconnected from their intrinsic value, either overvalued during manias or undervalued during panics. The question is whether you have the psychological training to recognize those opportunities and act on them when doing so requires you to stand apart from the crowd. That training is what Epictetan philosophy provides. Now, I need to address something that I've been implying throughout this documentary but haven't stated explicitly. This approach to investing is not for everyone. It requires a specific temperament and a genuine willingness to accept isolation. When you commit to independent thinking, you're committing to periods where no one agrees with you, where your portfolio looks strange compared to standard benchmarks, where people question your judgment. If you need social validation, if you need to feel that you're part of a community of like-minded investors, if you need regular confirmation that you're on the right track, this approach will be psychologically unbearable. Epictetus was writing for students who had decided they wanted to become philosophers, who had committed to the discipline of philosophy regardless of the social cost. Not everyone in Rome became Stoics because not everyone was willing to accept what Stoicism demanded. The same is true for investors. Not everyone should attempt to become an Epictetan investor because not everyone has the psychological capacity or the life circumstances that allow for genuine independence.
But if you're watching this documentary, if you stayed with me for the past hour as we've worked through dense philosophical concepts and detailed operational frameworks, that suggests that you might be someone for whom this approach is appropriate. You're not looking for simple tricks or quick strategies. You're looking for a comprehensive method for thinking about markets and about your own psychology. You recognize that investment success is a long-term project that requires fundamental changes in how you process information and make decisions. If that describes you, then I want to emphasize something crucial. The work starts now. Reading about Epictetan philosophy, understanding the concepts intellectually, agreeing with the principles, none of that produces results. The only thing that produces results is consistent practice of the specific disciplines I've outlined. You need to start your falsification journal. You need to execute the solitary analysis protocol the next time you're considering an investment. You need to conduct an emotional audit before your next portfolio decision. These practices will feel artificial and forced at first. That's expected. Over time, with repetition, they become internalized. They become your default way of thinking rather than something you have to consciously remember to do. And here's something I want you to understand about the timeline. You will not see immediate results. In fact, you may see immediate underperformance. When you start thinking independently, you will inevitably discover that some of your existing positions were based on herd behavior rather than genuine analysis. When you apply the consensus inversion test to your current portfolio, you may realize that you're overweight in popular assets that no longer look attractive under independent scrutiny. Correcting these positions will feel like admitting error, and it may result in near-term losses as you exit crowded trades. This is the gauntlet that every serious investor must pass through. You have to be willing to take short-term pain, both psychological and financial, in service of long-term improvement. Most investors can't do this. They start to implement independent thinking, they see some initial underperformance, and they abandon the framework and return to following the crowd. This is exactly what Epictetus would predict. He would say that these investors never truly committed to independence. They were just experimenting with it, keeping one foot in conventional thinking as a safety net. True independence requires burning the safety net. It requires accepting that you will have periods of underperformance, that you will make mistakes that look obvious in hindsight, that you will sometimes be wrong when the crowd is right. The difference is that over sufficient time periods, and we're talking 5, 10, 20 years, the advantages of independent thinking compound into results that conventional thinking cannot achieve. But you have to survive the near-term difficulties to reach the long-term benefits. This brings me to my final point, and it's the one that connects everything we've discussed back to Epictetus's core teaching. The ultimate goal of Epictetan philosophy is not wealth, it's freedom. Financial success is a byproduct of psychological freedom, but it's not the purpose. When Epictetus talks about being free, he means being free from dependence on external circumstances, free from the tyranny of popular opinion, free from anxiety about things you cannot control. The investor who has achieved this freedom makes better decisions because he's not operating from a place of fear or greed or social anxiety. His judgment is clear because it's not clouded by emotion. This is why I titled this documentary, Why Popularity is the First Sign of Financial Danger. It's not that popular investments are always bad investments. Sometimes the crowd gets it right. The danger is that popularity itself becomes a substitute for analysis, that the comfort of consensus becomes more important than the quality of your reasoning. When you find yourself drawn to an investment because everyone else is investing in it, that attraction is a warning sign. It's your brain seeking the psychological safety of the herd rather than the intellectual satisfaction of genuine understanding. Epictetus would tell you to notice that feeling, to examine it, to ask yourself whether you're making this decision based on your own judgment or based on the judgment of others.
That moment of self-examination, that pause between the impulse and the action, that's where investment success is determined. Not in the models you use or the data you analyze, but in your ability to maintain rational judgment under psychological pressure. So here's my challenge to you. Starting today, with the very next investment decision you face, implement the Epictetan framework. Write down your thesis before you examine what others think. Establish your falsification criteria. Conduct your emotional audit. And then, this is the hard part, act on your own analysis, regardless of whether it aligns with popular opinion. Do this consistently. Do it systematically. Do it even when it's uncomfortable. Track your results not just in terms of returns, but in terms of process quality. Were you true to your own analysis? Did you allow external opinion to influence your judgment? Did you maintain discipline when discipline was difficult? If you do this work, if you commit to it fully and practice it consistently, I can't promise you that you'll beat the market every year. What I can promise you is that you'll become a different kind of investor. One who makes decisions based on reasoning rather than emotion, one who builds positions based on analysis rather than popularity, who exits investments based on falsification criteria rather than panic. Over time, over the course of a complete investment career, these process improvements translate into superior returns, not because you're smarter than other investors, but because you've trained yourself to think independently when others cannot. Now, if you found this deep dive into Epictetan philosophy and behavioral finance valuable, if you're committed to building the psychological discipline that separates great investors from mediocre ones, then I need you to do two things. First, subscribe to The Rational Investor right now. Click that subscribe button, turn on notifications, and join our community of investors who understand that mastering the mind comes before mastering the market. We publish documentaries like this every week, each one connecting ancient philosophical wisdom with modern financial psychology, each one giving you practical frameworks you can implement immediately. And second, go watch our documentary on Marcus Aurelius and loss aversion. If Epictetus teaches you how to think independently, Marcus Aurelius teaches you how to maintain that independence during periods of loss and adversity. Loss aversion is the single most powerful bias working against rational investment decisions, and the Aurelius framework for overcoming it is essential for any serious investor. You'll find that video linked at the end of this one, and it's the perfect complement to what we've covered today. Remember, the work of mastering your psychology is never finished, but it starts with a decision. The decision to stop allowing popular opinion to determine your judgment, to stop seeking validation from external sources, to start building your own standard of truth based on evidence and rigorous reasoning. That decision is up to you. Everything else, the market's opinion, the crowd's behavior, the media narratives, none of that is up to you. Focus on what you can control, and over time, you'll find that superior returns follow naturally from superior thinking. The market will always present opportunities to those who can think clearly while others are thinking emotionally. The question is whether you've prepared yourself to recognize and act on those opportunities when they arrive. That preparation is the work we've been discussing today. That preparation is what separates wealth creation from wealth destruction. And that preparation starts now, with your commitment to implementing the Epictetan framework in every investment decision you make going forward. Before we close, I must remind you once again, all content provided by The Rational Investor is for educational and informational purposes only. It is based on academic principles in philosophy, psychology, and behavioral finance. We are not registered financial advisors. Nothing on this channel constitutes financial advice, investment recommendations, or an endorsement to buy or sell any security. Consult a qualified, registered financial professional before making any investment decisions. By watching our content, you agree to hold the rational investor harmless from any losses or damages resulting from your investment choices. Thank you for investing your time in mastering your mind. Until our next documentary, remain rational, remain independent, and remember, popularity is not proof, consensus is not truth, and the crowd's opinion is never a substitute for your own rigorous analysis. The path to financial success runs through psychological discipline, and that discipline is built one decision at a time. At a time, 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 at